All right, well, the markets started off the week on a relatively light note, a small range. We got a seasonally bearish week that we've talked about before with very, very little earnings announcements, a calm before the storm, so to speak. So I'm going to break down now kind of what to expect now the rest of this week and where the resistance support are on an intraday basis. I do appreciate we had some, for those of you who had issues with our website today. There was a reason why we had some back end issues. I appreciate those who emailed me and shared with me screenshots of what you were seeing. It really helped tremendously. I spent most of the day figuring out how to put that back together. But we're all set to go. So that's why we're able to get this video up and posted now. So let's go ahead and get started. Today is Monday, October the 7th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the market forecast with the S&P 500 first, like we always do, and we'll see how we've kind of held at some resistance in this 2950 area. So this area, which was the top of this Fibonacci retracement zone, the 23 to 78% zone. Also the 38% of this near-term run. So we have this intermediate run that these bigger Fibonacci zones are related to. Then we had this near-term rally that this smaller run is related to. And so, so again, we broke down below some important support here at 2950. Well, of course, old support is broken resistance, so that's going to act as a resistance on the way back up to 2950. Well, the intermediate posture actually fell below 50, so that's why we have the dark pink shading here. We have the bearish posture, but you notice the actual, because how bullish these two moves were, pretty much averaging out these two sharp closes. As a result, the 30-day moving average actually rose and is back to being a yellow because we're below it, a yellow moving average. So in fact, both of these numbers are actually higher than the equivalent two down. That's why your moving average is rising. So not quite the bearish pattern, not that you see on the Russell, and even the Russell too, same thing. These two closes are higher than these equivalent closes over here. So that's why, again, you have a rising moving average on that to a smaller degree than what you see on the S&P, but dark pink shading nonetheless. So but both of these, for the Russell and the S&P 500, you notice the near-term line has moved back into the reversal zone. So this is the first time these last couple of near-term highs have been below 80, or maybe a smidge above there. But this is the first one to really get above it. Now, granted, this is still a lower high. So not only do we have this resistance here, but that's the last near-term high. And that's the one I'm kind of mentioned before, that until you break through here, we're not really taking off. Not yet. At least there's also some, if you look at the Bollinger Bands here, let's go to the Bollinger Bands for SPY, in that equivalent area, you can see that's where another volume node is. So you have to clear that volume node before we really get going to the upside. But you can see, like right here again at this 2950 level, that's where the top of the value area is. So that's going to act as a resistance until you break on through that. At least we held the point of control and bounced off of it, but we could very well come back down and retest it again before we get going back to the upside. So kind of watch. I don't think that this will be the bullish run, simply because we're still pretty far below. This would be a lower near-term high. I wouldn't be surprised if we got a near-term pullback here early this week. Remember, from a seasonal standpoint, this is a bearish week. So I wouldn't be surprised if we didn't pull that near-term line back down below 50 pretty quickly here this week before setting up a bullish near-term low that's going to be a lot higher than this one, and then bounce so probably down into this area is what we might come down to, 29.25 area, then bouncing off of what would be a much higher low point, and then we'd get a new higher high and a breakout above 29.50. That's kind of my expectations going into the end of this week, and that would bring the intermediate line back up, and this is an intermediate pullback. So we'll see if we get a little bit of a cup and handle type pattern here, at least a higher low point, and we don't bounce off and get up to a higher high, higher than both of these intermediate highs. If we were to bounce back up and get that intermediate line back above 50 again, and get an even shorter intermediate run, and that did not last the 1 to 3 months. But if we were to get a shorter one, then that would be pretty bearish, especially if we don't get up to a new high. My expectations have been that we'd be bullish going into the year. I did thought that we'd get one intermediate pullback somewhere, whether it's in the middle or what it looks like this is it. Now the question is, are we going to get the rest of this intermediate run, that is, as is seasonally the case, into the end of the year? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen, then hit that red subscribe button that pops out. There's also one down below the video, too, if you're watching this on YouTube. That will notify you when these videos are posted. Also, while you're down there, click the thumbs up icon. That tells us two things. Number one, that you liked our video today, and number two, that you want us to do it again tomorrow. It's our one-click way to give us feedback. We check it for every video, so let us know down there if you'd like us to keep doing these. You can do that. Click on that right now while you're watching. Also, while you're down there, comment what stood out to you from today's video. What did you get out of it? Let us know down at the bottom. Join our website at marketscholars.com. For free, you can get access to our Market Outlook forum as well as our market commentary blog, among other things. There's a link popping out right there that will subscribe you to our site. Follow me on Twitter for more content in between these videos from day to day, and join our Facebook group that we've created for the Market Outlook video. Also, if you're watching our video on our blog here, I wanted to point out our upcoming events calendar. Just to remind you that Brandon is out of the office this week, so I'll be doing a paragraph like this for the Market Outlook tomorrow and Thursday, but no videos unless there's a significant amount of volatility tomorrow or Thursday. I'll step in and do a video. But barring any craziness, just look for just a regular paragraph here. And again, these are all my classes that are upcoming this week. Brandon's classes are off, so I know we have a lot of new subscribers here over this past weekend and past week. So if you're wondering, hey, I thought there was 8 classes this week. Well, there's 4 this week because those are all mine. Brandon's off. In a couple of weeks here, there'll be 4 again because it'll be all Brandon's and not mine. And then of course next week all 8, and after that will be all 8. We also invite you to engage with us on social media. If you hit this little heart, that opens up that window, and you can like today's Market Outlook tweet. If you click this image, it takes you to your Facebook page. You can like today's Market Outlook Facebook post. Again, the more you engage with us on those social media platforms, the more likely they will put our content or promote our content to the top of your timeline, so that you'll always ensure that you'll always see our stuff. So they do that with any content that you engage with, and with the content specifically that you engage with the most. All right, let's get back to the charts, and you can see, look at this week's chart here on the Hakinyashi handle. Look how small the range is already. So just like that, we had one big bearish candle, and we're already potentially forming another transition candle, potentially back up to the upside. So we'll keep our eyes on that. It's obviously only one day this week, so we'll be watching for that pattern throughout the rest of this week. From a 3 green arrow standpoint, we do have the 1 green arrow down here. The MACD's not there. We're still below the moving average. This is what it looks like on the 2-line version. We're below the 30-day moving average, and today's drop, especially at the end of the day here, actually got us back below the 8-day moving average, and both the 8-day and the 17 have crossed down below, with the orange line here crossing below too. So the MACD is rising, so that suggests that this little cross on the orange line might be temporary. So we'll watch this histogram to see. Right now it's rising back up to 0. If it rolls back down, then that means this MACD is pulling away from its moving average, and we're probably going to be pulling back down towards these lows. So 29.25 is one thing, but getting back down in this area is quite the other. Of course, the stochastics is low, but at least it's above its moving average. So there's some weak signs of bullishness, but not enough to say, we are turning this ship around. It's still some red flags that are showing up here. If you look at the intraday chart, as I mentioned before, we got this big block of volume here the value area in the past 4 weeks sitting on top of us right now. So it's going to be hard to get going, especially with the volume node kind of picking up here right around this 295 level. So it's going to be hard to get going to the upside. And again, you can see we filled in this gap. We got this gap down here. There's a decent chance we might pull back down towards 290. There's very little volume below here. Break below this, 293, 292, basically 293 level. A break below that level here, and pretty much below today's low point, the open, right near the open. But we'll probably fall all the way down. There's not very much volume at all keeping us up. So it'd be a very easy drop to 290 if we don't hold this low point. If we hold this low point and bounce back up, again, it's not going to be easy, but you can kind of see what we have to get through on the upside to really get going. It's not going to be easy to get going to the upside. We're not going to be hitting 304 anytime soon because barring any like trade related catalysts that could push you through that really quickly. Otherwise, it's just going to be a grind getting through all this volume. If we take a look at the volatility, today's volume first, you can see the volume was light, and again, heading up against resistance. Not surprising that volume starts to pull back in a very small range, 2.5 points range, 60 million shares trading on the volume. We put that into context here. 60 million shares is well below the average. 2.5 points is below the average too. And again, those are bullish numbers. So if we roll around and come down to that 29.25 area and are able to kind of keep the range small and the volume to average level or lower. I mean, both these lines are still in the lower half or easily in the lower half, but towards the lower end of their 52-week ranges. Again, that's kind of just shows how bullish this is. We don't want a bunch of big candles, big volatility, because that means we're going to be going up and down. And for the most part, if it's big volatility, it'll be going down. Volatility is ramping back up off of a low point here. Now the question is, how far up will it go? Will it go back up into and fill in that gap, the equivalent gap that you see on the S&P 500, all the way down to that 290 area? So probably gets our volatility back up above 19 if that happens, and then form a lower high point at that point. And you can see we're still in the neutral zone. We're not even in the bearish territory here. If you look at on the daily chart, you can see on the daily chart that we have the volatility. We're on our way down. It rallied today. We got a long lower shadow, but you can see a filled in body. And for the most part, after you have a rally in volatility, you tend to get a bunch of filled in bodies on the way. Sometimes you get lower shadows involved with them, but you tend to get the filled in bodies, and that's what we're in the process of getting right now. So before we take a look at some other charts here, just summarizing our technical outlook. We have a bearish posture. We don't expect this to be a continued. This is like a mid-cycle adjustment, so to speak, in terms of this bullish run that we expect to go through the end of the year. And we are in an intermediate pullback by definition. The intermediate line is crossed below 50, but the near-term line has made its way above 80. So this is a seasonally bearish week for stocks. We might get a little bit some weakness here in the short term. This near-term run might be temporary, might be shorter than normal. But then set us up for a new bullish near-term low point and a rally off of that to a new bullish near-term high, and then a reversal in that intermediate posture into the end of the year. So what do you think? Do you agree or disagree with that assessment? As always, love to see your vote. Click on that link right there. It's popping out in the top right corner of your screen, and hit either agree or disagree on that poll that pops open. If you click disagree, comment down below on what you're seeing that would suggest otherwise. Maybe you're a lot more bearish than I am. Maybe you're a lot more bullish than I am. For either way, let us know what you're seeing, that whether it's a chart or an indicator or whatever the case may be. Share that with our market scholars community down below. All right, as you can see today, let's take a look at just today's move. So this is actually October the 3rd. So give me 1 second to pull up today's. There we go, and then we'll go back to today there, 10 minutes. All right. So if we look at today's move, You can see the biggest losers on the day were emerging markets, along with long-term bonds and gold. Now, that's your typical scenario. Of course, crude oil started the day very strongly, and that kind of helped stocks get up to the upside. Crude oil lost its gains, and so did risk appetite as a whole. But, to a small degree, the dollar stayed pretty darn strong, and then, of course, bonds fell and gold fell. So if you take a look at some of these charts, let's take a look at them on the market forecast first. You see the dollar had pulled back. Look at that nice, good bullish engulfing pattern that we had today. This is so far here this evening. So nice, good bullish engulfing pattern today. It's near-term line running back up into the upper reversal zone. Light pink shading. We did not even get a yellow line. So we're getting we've seen this before where we've pulled away from the moving average, come back down to it, pull away from the moving average, come back down to it, and we'll see if we end up pulling away from the moving average again. If you take a look at the 10-year note, whoops, excuse me. If you take a look at the 10-year note, you can see it's got a pretty good margin of safety here in terms of it's about as low. I saw someone today, well respected, mind you, today said we're on the race to zero, and I don't know if we're on our way down to zero. Just because that's where they are in Europe doesn't mean that's where we're going to be here in the U.S. These are pretty low yields as we are right now, and again, as I've mentioned before, until we stop getting expectations for rate cuts, we're going to stay down there. You can see the rate cut odds are 71%. They did bump up to 30% that we won't get a rate cut in October. But remember, again, by December, which is really what matters, there's still an 85% chance we'll get a rate cut. That's still a pretty high probability. Of course, after that, you notice now we're down to about a 75% chance of a second cut into next year. And that's really a pretty high number too, but it's not, and that's numbers higher than what it was. So we're not, and that's actually closer to 70 than it's 75. It's not baked in the cake in the least bit. So as the yields rallied here and held up, and the dollar is bouncing back up, then the odds of a rate cut are coming down again. More than likely, you get one more, but after that is what matters. And the markets, as much as they like rate cuts, we don't want an extended run of rate cuts. We want it to be truly a mid-cycle adjustment like we've seen in the past, and that typically is pretty bullish for yields. So you'll see yields, once those cut odds start dropping beyond this next one that we're pricing in, you'll see yields really start to take off at that point. You can see gold is really rolling over. It's still got it's got light green shading here, but you notice we're on the green line. If the dollar continues to rally up, look for gold to really push its way down. If you take a look at the long-term chart here for gold, you see there's an opportunity to really fill in the gap between that 50-day moving average and the 200. We have such strong momentum, and when you got such strong momentum and you start to fill in that gap there, we can get down there pretty quick. So that's kind of what I'm expecting with the strength in the dollar. Keep that in mind in terms of any kind of gold-related trades you might have, especially related to gold miners. They could be adversely impacted by a drop like that in crude oil, and in gold prices. Crude oil, on the other hand, you can see it's also really falling down here. I mean, it had a really down day today, coming off of its highs. If you take a look at let's look at its market forecast chart here. You saw the Hakinyashi candle is bullish, and you notice, I mean, we're coming off of a cluster. We're bouncing up to what looks to be a bearish near-term high point and potentially a rollover. And again, it's at a pretty tenuous level here. If we break through this kind of 51.5 level to the downside, get down to 50 and beyond, then there's pretty decent odds that we might be bearish here for a while. You take a look at it here, and that's not typical, right? That wouldn't be a typical scenario. You can see what would happen how far down we can go. That wouldn't be typical for a bullish run, but that is typical for this time of year. Seasonally, crude oil is bearish heading into the end of the year. Here's our seasonality chart, and then we'll go into the 20 years. and do the prices percentage. So you can see, this is typically a bearish time of year for crude oil, and we'll see if that ends up playing out over the course of the next few months, even with a bullish market. You can see yields typically bottom out around here, and they rally up off of lows through to the end of the year, and that would again coincide with the bullish market as well. You take a look at the dollar index and you see what its seasonality is. You can see it's typically bullish heading into the end of the year. So we'll see if that ends up playing out as well. And of course that has a negative impact on gold prices, and you can see this is about the time of year gold peaks. And there's some volatility. It doesn't go straight down, but it doesn't really go up anymore, with some downward volatility during this period of time as well. Let's take a look at the foreign markets, the major foreign markets. Of course, a lot of dark pink here, of course, and we've mentioned this before. Not only do you have it in the United States, but you also have it in the UK, Germany, and France. India and Russia are a couple dark pink shadings from a emerging market standpoint. Canada, you can see, is down here as well, kind of mimicking the US. Brazil had a down day, but is holding up, and Japan and Korea are kind of holding up together as their little trade spat appears to come off the book, so to speak. And Italy, compared to its peers over in Europe, is also doing a little bit better. So you can see where the strength is, and look where the strength is in China, and that might be a reflection of growing expectations that things can resolve themselves between the U.S. and China going forward. All right, if we take a look at now at the sector performance, and you can see from a 3-month standpoint, we continue to have the safe havens leading the way to the upside, despite the significantly to the upside, mind you, despite the fact that we only have a 1.75% drop on the S&P. Of course, your cyclical areas continue to be your bearish areas. What was bearish continues to be bearish. Materials, energy, healthcare, industrials, financials are all laggards. And if you take a look at just how they performed here today, let's take a look at that here for the 7th, and we'll just go to 10 minutes. You can see again, the biggest winner, really the only winner, was the communication services, and it was a small flat day by the end of the day, giving up all of its gains. At one point up more than 0.5%. Energy struggling still to the downside, and you can see staples in one of those safe haven areas giving back some of their gains. Industrials also lagging behind for most of the day today. Little bit of bounce up in the middle of the day before falling back down. In fact, everything kind of bounced up in the middle of the day, and then everything fell right back down, except for utilities. Utilities stayed weak throughout the day. Real estate kind of matched the market and outperformed here briefly during that pullback, and then you can see by the time all was said and done, during it lagged behind during the rallies, and held up during the pullback. So it finished, like utilities, above the S&P 500 by the end of the day, whereas staples never was able to get going again. All these cyclical areas pulling back down. All right, so that leads us to our trade idea of the day. And really quickly, just to remind you here, every day that we do one of these trade ideas, of course, we always continue to follow these all the way to the time that we close out of them. And we manage those trades in the Market Outlook live videos day after day. We didn't do one today because of the technical issues on the website, but I got those wrapped up. I'll probably end up doing one of these on Market Outlook Lives tomorrow at 1:30. I'll send out a telegram, an alert to all of our premium subscribers and let you know there. But this is the link that takes you to that review video that's also available for all of our Plus subscribers, where we take all the trade ideas we've ever done and we manage them all the way to the time we get out of them. So that way, and it's not just a hey, here's an idea and we never talk about it again, like you see on so many other videos. But here, the educational process is the most valuable part of the educational process is managing the trade, not just getting into it. So keep that in mind. We'll continue to manage today's trade as well in that video. So let's take a look at what we do today. So It's actually on DuPont. If you take a look at the market forecast indicator here for DuPont, you can see, things are we had like a dead cat bounce. We had a big drop. We continued to gap down, then we bounced up, and now just like that in one day, rolling right back down to the downside. And we don't have the red line yet. We have the dark pink shading, but considering how low we are, we'll probably get a red line here as early as tomorrow on the market forecast. If you take a look at the 3 green arrow chart for DuPont, you can see that its 8 and 17-day moving averages are crossing below. The orange line's crossing below zero. Stochastic, the MACD here, as you can see, is rolling back down, getting lower here. If you look at the MACD histogram on the 1226 day, which is, we use the 50-day moving average with those two, and you can see it's also, after one day of moving up, bouncing back down on this dead cat bounce, and the orange line on the 1226 about to cross below zero. If you take a look at the long-term view for DuPont, you can see we're basically pulling away from the 50-day moving average as it's rolling over and with declining momentum. You look at its Bollinger Bands, where we are below the value area, which makes it, again, path of least resistance to the downside. Especially as we get below these volume nodes, the only volume nodes left on the 1-year chart. The DMI will tell you that we have a good positive or a good negative pattern here, where the negative directional index is well above 25, and the positive has dropped back down with today's move back down below 20. So a good negative pattern, good bearish pattern for DuPont there. If you take a look at the Ichimoku cloud, you can see the trend strength is pretty noisy right now. We've got a noisy pattern, but we're starting to develop a bearish pattern here, and we're getting back below the low end of the getting below the low end of the below the cloud, excuse me, and you can see we'll be below, like right now you have a bullish pattern here with the red line. But with the prices jumping up as fast as they are there, that red line, unless we continue to move up at the same pace, that red line is going to get below the candles over here and would represent a bearish pattern on that as well. So with that said, we can look at doing a bearish trade on this and selling the $70 call option here with 39 days to November expiration, buying the 72.5. Now it does have here, get rid of that one. It does have earnings coming up before November expiration, so we have to manage that with our position sizings. We don't position size like you do normally. There's a smaller position size than normal, and then of course we'll close out the trade if and when our loss gets to the equivalent level of what our maximum gain is, to try to keep our risk at 1-to-1. If we can get most of this reward, at least half of this reward, pretty quickly, then we'll just take it and move on to something else. All right, and that wraps us up for today. As always, you've heard from me now. Now I want to hear from you. Use that link that takes you to our Market Outlook forums. Remember, any free subscriber has access to our Market Outlook forums. Open up any new thread with any questions or comments you have about today's video or anything we discussed in the video, or for that matter, anything we didn't discuss. Maybe you saw something out there that pertains to what we discuss here that you want my take on. You can open up a new thread for that as well. You can also reply to anybody else's thread, and let's keep this conversation going here between now and our next video. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on video down below. Follow me on Twitter for more content in addition to these videos, and join our Facebook group that we created for these Market Outlook videos as well. Have a great rest of your evening, everybody, and we'll see you all next time.